Hi, I'm Merryn Somerset Webb, and I'm here today with Hugh Henry, manager of the Eclectica Fund. We are going to talk about everything from China to the US to Europe to Japan. But Hugh, I just want to start by asking you what you think makes a successful hedge fund manager, and whether you are, under that definition, a successful manager.
I think I've always answered that question by relating it back to the ability to conceive of a contentious posture. I think if I was to quote from the Fight Club, I think there's a famous saying, would you rather, my children always say that, would you rather upset God or have God just ignore you? And there's a degree to which being a successful macro manager is upsetting not only God, but the rest of the world, if you will, by being out there with the articulation of a qualitatively intelligent argument which just isn't shared by the majority, but which can stand the test of time and come to actually define the future. That is what global macro is all about. So with regard to language, the notion of bullish and bearish, I think, does it an injustice to the complexity of the arguments that are necessary to construct a global macro hedge fund. And I think if I had my time again, I would have been saying that we're actually perhaps guilty of misconstruing a bull market in equities for what is actually the ongoing degradation in the soundness of the fiat monetary system. I think that's what I was trying to say, especially when I cast my mind back to my infamous investor letter of this time last year.
The interesting thing is that you have a reputation of being something of a perma-bear. People think of Hugh Henry, they think of bearish. But what they're really thinking about is your macroeconomic ideas, not your investing ideas. So they're remembering your views on deflation, which by the way you've been correct on, right? They're remembering your views on deflation, and then they're remembering your previous views on what might happen to markets as a result of that deflation. And the change last year was to think about, not to change your views on the economic condition, but to change on your views on how they would affect asset markets.
Yeah, very good point. And I'm sure everyone's aware that we as a business have experienced quite a substantial amount of redemptions from the fund. And there was a degree to which there was that pigeonholing, and that of being a bearish diversifier, if you will, to an investor's portfolio. After all, I was the guy who made 30-odd% in 2008. And that's out there. And of course, with the redemptions, there was the notion that I turned into, rather than a diversifier, a concentrator.
Well, there was also slightly the idea that you had somehow capitulated.
Indeed.
That you'd given in to a bull market that you'd refused to accept previously.
Yeah. As such as my performance cabaret persona, I certainly would have alluded to that notion. And a degree of mea culpa. Again, what it is with me, I'm weird. So as you cast your mind back, the last time I was really angry was late 2010, 2011, where the market, in its wisdom, had yet to configure the changing economic landscape. And it was perceiving that the economy in Europe and elsewhere was recovering, and therefore the fixed income markets were beginning to price in a very high probability that central banks would raise their overnight rates. And to make matters worse, of course, the ECB, when it was governed by Trichet, actually came to the fore and raised rates. And I thought that was just insane. That we weren't capturing the kind of deflationary zeitgeist that was approaching. And so with that anger, if you will, I really took on a lot of risk. I was long fixed income, and in the vernacular, I was receiving interest rates. So essentially, I had a large fixed income bet which said these rate rises will have to be rescinded, and the expectation that there will be further rises are just not going to happen. That proved to be correct, if you will. And that was my last moment, really. I have to say, when I look back in the last 3 years, it feels as if the sun only rose each day to humiliate me after that point.
It hasn't really been quite that bad.
Well,
has it?
Quite, indeed.
Really?
In my mind, at times it's felt that. But the mea culpa that I think is very necessary is that I found myself unable to forgive the Federal Reserve and the other central banks for, if you will, bailing out Wall Street from the excess of 2008. I just couldn't get over it, and I luxuriated, if you will, in the polemics of a Mark Faber, a James Grant, and Nassim Taleb, in our own country, Albert Edwards et al. I luxuriated as they ranted. Now, it was fine for them to rant, but I am charged with the responsibility of making money and not being some moral guardian, certainly not a moral curmudgeon. And I had to get over that. And so again, back to my infamous letter of last year, that was cathartic for me to say, you know what, I get it. And I think hopefully we'll go on now try and explain the qualitative arguments behind why we are more receptive to the notion of not only left tails where markets can fall, but the right-hand tail of the expression where markets can actually continue to rise, if not to accelerate.
But the key point from talking about Mark Faber and Albert Edwards, etc., is that you don't disagree with these people on the fundamental economic condition of deflation. You just disagree with them on the effect on markets of central bank behaviour and on the longevity of that behaviour.
Increasingly, I have to say, I just disagree with them. I've literally, and with the utmost respect, I've turned the volume down to zero. Previously, they were like sheet music. When I read it, I could see the trades appear within, in front of me, if you will. And I hear now, I just don't hear the sound of music today. That's my difficulty. So I really feel very, very isolated from their view of the world. And arguably, but we're talking about the here and now, and the future's a long time, but in the future I'm sure our paths can converge once more.
Okay, well, let's talk about your view of the world now. Last year there was the infamous letter, the great bullish letter. Is that something you'd be interested in? And as you say, your client said, no, not really. Can we make them interested now? Is there something you can say to your clients now that would re-interest them in this concept of the great bull?
Well, let's have a go. Because there are two things unfolding. Hedge funds, and within the broad church of hedge funds, macro hedge funds are struggling to make money, and there is a dissatisfaction with that, and I'm not the only manager to have suffered withdrawals.
Why do you think that the sector as a whole is failing to make money? What's going on there?
Well, if I can't be a spokesman for other and far better
But I'm
managers.
sure you can allow yourself to comment on them.
But I can reflect on my own difficulties, if you will. And what I've found is that macro is distinguished, I believe, by superior risk control. It's almost analogous to a disaster insurance program. In 2008, all the good macro managers, they made you money. That's what you pay them for. The world became profoundly unsettling, and you cashed in your insurance policy. Today, I question the relevancy of that disaster insurance in a world where the central banks seem to have your back, seem to be underwriting risks in global asset prices. Do you require that intense scrutiny of risk? So when I look at my fund's not dissimilar to others. We go out of our way to avoid traumatic periods of losing money. And for us, typically that would be defined as losing 5% or more in 1 month. And such, I think, is our capability, that we have 12 years been running this fund, so 144 monthly observations. Mm-hmm. And out of that, we have had the indignity of suffering 9 such months. So not that many when you consider the tremendous amount of either bull market or bear markets that has gone on. But it forces you, that disaster scheme, if you will, or prevention scheme, it forces you to reduce risk, which is to say, to sell the things you like when they go down in price. And notably this year, so if I had constructed this argument that I wanted to be bullish, yes, and yet with risk control, I found myself a seller at lower and lower prices. So lo and behold, it became impossible to fulfill my mandate and to make money. And I think that is a problem that I shared with many others. Now, I have again, I am introverted, and I look and I examine my own behaviour, and I've concluded that my risk tolerances were too tight, too taut, and it was creating too much of my own intervention in the portfolio, and it was damaging to the client's performance. And so I've pulled back, or I've widened the tolerance of the portfolio.
Okay, so your basic point here is that if the central banks have your back, there's no need to have the same kind of risk controls that you used to have.
There is less need.
Less need.
And I tell you, I was at a conference with some of the great and the good global macro managers in September in New York, and I asked them all the question: if the S&P is down 12%, what are you doing? Are you selling more, or are you buying? And guess what? They're all buying. And so the central banks have created a behavioural tick, which is becoming self-reinforcing, and I believe we saw another manifestation, of course, of that behaviour in October. So when I look at the year, I started the year hugely bullish on Japan. Hugely bullish, let me say, not qualitatively. I'm not an advocate of three arrows and the resuscitation to the great heights of whatever Japan represented in the 1980s. I am saying that I can see persistent failure to achieve such honourable ambitions, which leaves no recourse but to intervene again and again and again. And therefore I see the yen being a weak currency, and the other side of that, the stock market being higher and higher and higher. But within, I think, 4 months of the year, the Japanese market had fallen 16% from its high. And I had to swallow my pride, and I had to reduce position. I had to sell lower prices. And yet such is the foreboding presence or shadow cast by the Bank of Japan that not even if we mentioned the recent intervention, without that intervention, the Nikkei had got back to its previous highs. So I was wrong in selling. And again, over the summer, the European stock markets had a similar decline, even greater if we look at the banks index. I think it was down over 20%. And what happened? The ECB responded, it took its rates negative, and it committed to re-engaging, reutilising its balance sheet to acquire European risk assets. And prices rapidly rallied from the middle of August into September. Why did I sell? So thankfully, you only make those mistakes a few times if you're wise. And so when we came into October, I got it. And that, as a discipline, meant we stayed invested in the month of October, and indeed were able to buy more equity risk towards the middle of the month, which is to say we made money in October, we made money in September, and we made money in August. So, if you will, it's not just the narrative, it's the risk engagement and giving trade expressions the room to breathe such that they may prosper.
Okay, so the simple message here is, in a market like this, never sell anything and you'll be fine.
You can say that, but I cannot.
Let's move on to looking at markets more specifically.
Yes, I see this, and we've just discussed the travails of making money for the global macro community. Mm-hmm. And what I want to say again is contentious. I want to say this is almost unparalleled in being the most exciting moment for global macro today. And I predicate that upon making an analogy with the central bank coordinated policy intervention in the foreign exchange markets after the Plaza Accord in, I believe, 1985. There was a profound unease at the current account, and particularly the trade deficit that America was running up, especially against the Japanese, which was deemed to be contentious. And the central bankers agreed that it would take too long for the real economy. The real economy is composed of slow-moving prices. Wages are slow. And the notion of having to wait for productivity improvements and wage price negotiations to work their course via the US landscape, corporate landscape in Japan, such that those balance or deficits would be resolved successfully and become less politically contentious, it was just too long. Politicians just don't have that time. And so they jumped into the world of macro. Macro is all about fast moving prices. Foreign exchange is fast. Stock market prices are fast. The S&P, all stock markets last year were up 30% in dollar terms. Fast. And so the notion was the yen and the Deutschmark would appreciate. Now, hedge funds, that was an amazing, this is the period of the alchemy of finance. George Soros has celebrated in very successful financial adventures. And they just ran the biggest long positions. Now, no one stopped to say, well, the Deutsche Mark's getting expensive. It didn't really enter into the vernacular of trading in that market. It was macro. There was a policy impulse of sponsorship by the world's monetary authorities, and you were trending, you had to have that position. And by and large, it succeeded. And so what I would say to you today, that today the policy response can't be found in foreign exchange markets. It's being muted somewhat by the beggar thy neighbour, that everyone can pursue the same policy. So currencies, up until very lately, haven't really moved that much. And instead, the drama is unfolding in the stock market. I would say to you that policymakers are so absolutely beside themselves with regard to how structural these deflationary forces are, and that they recognise that they really have very little to offer once policy rates are at zero, and you have the zero lower band, that they have to stave this crisis off. You cannot have deflation today. And I believe they are now responding to the fast-moving circuit of the stock market. And clearly America has demonstrated something. That policy response underwrote a very virtuous cycle of higher asset prices, which, if you will, rekindled a degree of animal spirits. There's greater credit demand within America. Now, allied to the shale oil gas revolution and the weakness of the dollar over the period. But the US today is deemed to be the most robust economy with the greatest probability of escaping the stall speed.
And telling us that QE worked.
It's all about which degree does it work, which planet, or which, and certainly at that level it worked. Now, if you wish to take the other side and say, QE doesn't work, okay, it worked by redistributing. It doesn't create wealth, clearly. What it aims to do is redistribute economic growth from one part of the global system to another. So as the US has come to the forefront in the last 5 years, China's found its growth rate has, from this perpetual notion of 10% GDP expansion, it's now 7, and everyone's scratching their head and has great doubts that 7 can be maintained.
You don't really believe it's 7?
It's fugazi, whatever. Yeah, it is what the market is willing to entertain, and presently that's somewhere around the 7% level. So QE, if you will, has succeeded in that redistribution away from the Chinese mercantilist axis back into the American axis. So I believe that clearly in Japan, I think when they look back now, they see that's the trick we missed. We missed the fast-moving reaction of equity prices. Sponsoring higher equity prices would be a means for companies issuing equity, reinvesting in their businesses, employing people, raising prices, and getting this thing moving again.
So you feel the Japanese coming around to the American style of QE, but wanting even to do that in double time?
Yeah, absolutely. To catch up for 25 years.
They're doing sudden huge
behind.
catch up.
Huge catch up. And now the problem, the perception that I have of a problem is that that's when the moral curmudgeons step in and say, this is all crazy, I disagree with this, I'm not playing.
So they make their disapproval a reason not to play the game.
It won't work, and so they don't participate. Equities are overvalued, and I'm going to tough it out. I'm just not going to be in that market. As I say, there was a time in my life when the sun only rose to humiliate me, where perhaps I shared that. And it's bunk, it's nonsense. It may not work, but presently the perception is that it will work, and those asset prices are trending, and you should participate. And then within Europe, such is the political time frame, and the stakes are so enormous that it has to work now. We have the French elections, national elections, are in 2017, and we have been caught with, because they raised rates. As I say, when I was last in rates, they raised rates, and they've been slow to this game of quantitative easing, and as a result, they are clearly behind the curve. And so economies from France to Italy and others have been unsuccessful in bringing these deficits below 3, which of course then imposes further austerity measures, which are just toxic in the political, social space, and we're seeing radicalization of policy. It may be contentious to say, but if the French election was held today, I would worry that the Marine Le Pen party would win. And that's not to say necessarily to cast aspersions on that side. It's just to say that I think the thrust of her policy would be to take France out of the euro. So my point is that so we've had this year of a further year of deleveraging the European banking system, deleveraging the commercial space. And these very slow moving prices, wages are still not moving, prices are still not moving, if anything they're moving the wrong way. And Europe needs high equity prices and high animal spirits. And then you get people feeling more confident about the collateral, the banks feeling more confident about the collateral that underwrites their lending, they'll be more willing to lend, and slowly but surely we will re-engage and we will get growth perhaps on a par with what you're seeing in America today.
So you're pretty certain this is going to happen in Europe, that it can't not?
One can't be certain about anything, but I'm certain that it's a policy underwritten by the central banks, and as a macro manager, I want to put myself alongside their impulse and their desired intentions. Whether with Europe just now, Europe is the most contentious because politics enters the arena. Will the Germans allow it? I may apologise for my caricature of a wonderful nation. My only point there, I have 2 points there. First of all, Angela Merkel, back in the day, had the chance to appoint Axel Weber as chair of the ECB. So, good German, the German orthodoxy would prevail. And there's one thing that characterises Merkel, and she is a pragmatist. And she doesn't have that same ideology that we see from other parts of the German church. And she passed him over in favour of Draghi. I think that's huge. I think she recognised that if Weber had been in charge, not to do him an injustice, but that German orthodoxy, the euro would not have survived.
She would have taken away the options.
Yeah. So she's already, if you will, on the political side, I think, shown a willingness to endorse. And what the ECB's gone on to do is remarkable, in terms of what we thought it would be capable of doing. But of course, we keep hearing the showbles of this world, the German finance minister, ranting that either the injustice or the fact that QE doesn't work. And again, maybe he's right, maybe he's not, but I think we have to try anyway. Now, the point is, Merkel is more popular than her party. And I think she's more popular because she has that pragmatic European view rather than the ideology that we hear and of course is disseminated through the financial press. So I think it's less, I think the Germans perhaps are less dogmatic than we believe, but I don't know.
Go back briefly to the moral imperative. The people who are very angry about QE, say in Japan, etc., who disapprove of it, they would say the moral imperative is not to do QE, but you've just suggested that for you, the moral imperative in Europe is to do proper QE.
Well, desperate times breed desperate measures. The policy errors, I believe, the fatal policy errors are all in the past. Economies across the world were allowed to take on so much debt that they have, and taking on debt, you're borrowing from the future, you're borrowing consumption to spend it today. So we overinflated GDP growth rate. Right? And there's no surprise to me today when people are disappointed by today's growth rate, because it's like, I ate your sandwich yesterday, it's not there. So I don't see a clean solution. I see this as a grubby solution, but it's closer to being a solution than anything else that I can conceive of. And with QE, again I say, I think we barely scratched the surface in terms of what will happen. I think it will spread into central banks essentially having to endorse higher government budget deficits to sponsor public work projects or favourably to sponsor tax cuts. I think that is in the future because we have not resolved that deficiency of demand, which of course is a function of having over borrowed from the future to spend yesterday.
Okay, so more complicated, if it can get more complicated. How does it end? and we can talk about the money printing going on forever. We can talk about the different ways that can be used by central banks to try and stimulate demand, etc. But one day, it has to come to an end.
Indeed. So,
what makes that happen?
So if I may segue into that answer by challenging the notion, the popular notion, that quantitative easing has distorted and manipulated public markets. Again, I think I used the term earlier, bunkum. Absolute nonsense. Absolute nonsense. JGBs, if we take an example, are fairly valued. The economy just fell 7% in the last quarter on an annualized basis. There is no inflation. They've had 25 years of no real GDP growth. Where would you expect JGB bond yields to be for a fiat currency that can issue its own paper currency? US Treasury bonds, where should they be? I struggle to see. Again, I think Dylan Grice was the great architect of the notion that you can define the upper bound to today's interest rates by trying to determine society's capability to meet those interest rates at higher and higher levels. And what you find is we cannot live with a Paul Volcker and putting interest rates at 15%. It doesn't work. There's so much debt that if you reprice debt, the economy slows down. And we saw that, I think, 2012, you had after the taper tantrum, and 10-year bond yields went over 3%. What happened next? The economy slowed down. So I don't think JGBs are the wrong value. I don't think US Treasuries are the wrong value.
Equities?
I would say to you, if anything, I would be a buyer of US Treasuries, and I'll come back to that. US equities, some of the best companies in the world who have exceeded all expectations, both in regard to growth and returns on capital. And we've just had another quarter of earnings, and they continue to do it. Valuations, again, fugazi. When it comes to valuation, one man's high valuation is another lady's low valuation, or what have you.
You've just lost interest in valuations, haven't you?
You can't. It's a bit like the Supreme Justice. What's he called? Potter. In 1964, there was a successful prosecution of a cinema owner in Ohio for showing a French movie. It's always a French movie. And he was charged for the notion that there was pornography. And so he was charged under the Obscenity Act. And it was overturned. And Justice Potter went on to explain that the Constitution allowed for obscenity, except for hardcore pornography. And he didn't feel capable of defining hardcore pornography, but he felt sure that he'd be able to recognize it should he see it. And that's my take on valuation. I'm pretty sure I'll recognize it when I see it, but today, I don't see it.
Okay, take me back to US Treasuries. You said you'd be a buyer of US Treasuries today. That's a pretty contrarian view.
Well, we are long 30-year Treasury bond yields. This year we have, I think, been among a select group of macro investors who've actually made money being long US Treasuries. It's been a very popular trade, being short. It's particularly relevant today with the notion that following the Jackson Hole central bank soiree, if you will, in late August, that there seems to have come out of it some notion or tolerance that the dollar would rise. Now, typically that's the fiefdom of the Treasury and not the central bank, but we'll let that pass. The dollar has been on a tear ever since that meeting. And my take on that is that I think America looks at it, increasingly feels confident, rightly or wrongly. I'd err on the caution, but feels confident that it is largely resolving the issues stemming back to 2008. But when it looks to the global theatre, it's desperately concerned about China and desperately concerned about Europe. And so the last 5 years were, if you will, it redistributed global growth. And by redistribution, bear in mind, I'm saying that quantitative easing, as pursued by the Federal Reserve, had the explicit policy aim of ensuring that the dollar would not rise. The dollar always rises when there's a deflationary crisis in the marketplace. The dollar index was trading at 80 pre the events of late 2008. It briefly flared, and then you had quantitative easing, and it sat at 80 for 5 years. And what it's been doing is America's been determined that dollars earned in America create jobs and prosperity in America. Whereas in the last 10, 15 years, the mercantilist axis of Europe and of course China has meant that those dollars were exported via the trade deficit to elsewhere. That just couldn't be allowed to happen. That hasn't happened, which is to say that again, boosted by shale oil, of course, the trade deficit has been falling.
So the growth has remained in America.
Has remained in America. And I think now, given the kind of perilous poker game that we have ongoing, I think America now is willing to be less curmudgeonly, more generous with that smaller pot. It may not be a great expanding pot, but it's kind of Buggin's turn. It's time for the other guys to kind of get
that brings us, I guess, to China.
But in that view, I think that's therefore, if the dollar does continue to appreciate, I think the likelihood is that the US rates would converge with the rest of the world, which themselves seem to be converging with Japan.
That takes us to China. And you were one of the first to point out the major problems in China. You did your rather amazing video wandering around empty housing estates, etc., which I think was pretty well watched. What's your view now?
I think my view would surprise you. Before I surprise you, I would like to seek legitimacy with the view by telling you that I have made money. It's been my most successful profit center in the year to date, and we've made over 5% trading in China-related macro themes. In terms of surprising you, I am more sanguine about China, and actually I've been rather impressed by their policy responses over the last 2 years. When I look at China, China has got two components. It's got this manic investment, gross capital formation, and something which has been deepening these global deflationary fears because they kept expanding over capacity industries such as cement and steel and undermining prices in the rest of the world. That in itself, if you will, lowers these inflation figures below central bank targets, becomes reflexive, and then the central bank says, crikey, I've got to be radical here, I've got to buy equities. So there's been that going on. On the other hand, there's been a kind of robbing Peter to pay Paul, and that China's had a decade which has been very, very similar to that of the US in the 1920s. The US, people forget this, but Liaqad Ahmed, I've just destroyed his name, forgive me, but the Lords of Finance author. Yeah. I reread it recently, and I was very taken by the notion of how mean the Fed had been in the 1920s. Again, I said to you with cathartic crisis, the response for the rest of the world is to be long dollars invested in America, and that was certainly the case in the 1920s. But America was recovering nicely from the Great War, and it had this incredible productivity revolution, and there was great demand for credit. And so it was fine on its own, but the rules of the gold standard meant that as Europe kind of pushed all of this easy credit to America via the manifestation of these gold balances, the US growth should have been even more intense, that the Federal Reserve kind of had a moral obligation as part of the game of the gold standard to let loose that gold into the economy via bank lending. And it didn't. It was very, very hard money doctrinario, and it withdrew that gold and it buried it deep in the vaults. And it's never really been reflected upon because we just know that America boomed. The argument is it should have boomed even more, and if it had done so with even greater ferocity, and this is counterfactual, so Niall Ferguson will kill me, but
it's alright, he's not here.
But if it had, then perhaps it could have resuscitated especially poor old England or Britain, which had gone on the gold standard in 1925 at a desperately poor moment. It would have given it the rationale that you went on for the rules, and the other guy, the big guy, didn't play the rule, and you got squashed. So counterfactual. And I think it would have created more price inflation, and so US rates would have spent a decade on the floor, and asset prices, they would still have bubbled, but I think the bubble would have been earlier and could have been dealt with. counterfactual.
Okay, well, we'll never know about that.
We'll never
How
know
does that
that.
connect to China?
So the meanness, China's had a very similar decade where such with a huge returns on investment on offer because land prices are low, labour's low, you can borrow money, the currency's cheap. So you wanted to manufacture, you want to have business in China. And so the rest of the world, en masse, you had, if you will, it's like that gold transfer from the 20s. This time is via fiat money and institutional portfolio allocations into China. So China should have boomed. Yes, it did. It boomed. Okay, but it should have boomed even more. Rather than growing at 10%, it should have been 20%. I'm making these figures up. The reason it didn't was that they, as I said, they robbed Peter to pay Paul, and they took the great bounty of the productivity leap that their household sector, their workers were achieving. They got paid more, but they should have got paid way more. And their currency appreciated, but it should have appreciated way more. And they got negative interest rates when they put this hard-earned capital back into the system. So they got screwed, if you will, on three fronts. And as a result, consumption declined. It didn't decline because they were just more cautious and these kind of incredible Asians that just want to save. Nonsense. Their income got constrained versus its capability. So consumption incredibly low as a percentage of GDP, and this manic deflationary capex boom very high. Mm-hmm. And the last 2 years it looks as if they've sought to challenge that. The bullish take on China is this 35% of GDP. Through proper husbandry, that could continue to expand 10% per annum. And that underwrites a 4% floor to the Chinese economy, clearly if you do the maths. So how would you do that? Well, you would take away these negative interest rates. Mm-hmm. They've done that. Either in the misfortunate means of the higher risk from these wealth management products, but with these internet platforms offering money market rates. Yeah. Okay, so there's a movement. The currency has appreciated, much to the chagrin of those at the beginning of the year said, "Oh, it's going to devalue," and they're going to tell you that it's going to devalue. On the currency, again, valuations, fugazi. When I look at it, I see an economy where the urban population is fully employed. I don't see an inflation problem. It seems to be able to compete in the world, and it's finely balanced. So I'm not sure, is the currency overvalued, undervalued? It's kind of close to fair value. Yeah, we're long the currency actually. And lastly, just on that, but the wages, and wages have grown at a tear. Yeah. So the consumer is enjoying a dramatic relative improvement in its lot. Okay, and I think that's one argument that doesn't get a mention. So the notion of a Chinese devaluation would be exactly the wrong policy, because of course you would then be killing the household sector again. The goose that could lay the golden egg has to be cherished, and it needs a rising currency, I would argue.
But you're assuming that the correct policy will be followed.
Well, it has been to date, that they haven't panicked and gone into that crazy splurge in 2009, 2011. They haven't done that. And then the other point with China is, so it's a bit like the US. It's had its excess. The problem in the US was it was felt intently with the private banking system, which went bankrupt. But, and this is not counterfactual, what if what if the state is the banking sector? Does it have a Minsky moment? And I would say it doesn't. So the whole game with Fed QE was to underwrite the collateral values to keep the credit system moving. So it aimed its fire at mortgage obligations more than treasuries. The whole deal with LTROs in Europe has been, again, to when investors are valuing banks at 40-60% discounts to asset value, the central bank's coming and saying, actually, we'll buy it from you at full value or something higher. So we are going to endorse the collateral of your assets. And in China, it's the same deal. They're a fiat currency. They can kind of get away with this, and they are. So it's like to bet against China or Chinese equities or the Chinese currency is to bet against the omnipotence of central banks. One day that will be the right trade. I'm just not ready or sure that that is the right trade today.
Okay, so yes, what are your China trades now? You said there were 3 different.
This is a technical trade, but we have been paying interest rates in the offshore market. So interest rates, the Chinese currency for many, many years has appreciated at an incredibly unvolatile manner. And so you've been able to borrow money very, very cheaply by going along the CNH. And then through surreptitious means such as the over-collateralizing of bills of credit or using commodities, but through guile, if you can take that cheap money and get it onshore, then you can invest at a wealth management product from the guy down the street at 15%. So it costs you, your cost of capital is 1, it's 15. When you go to pay it back in a year's time, your liability has been diminished because it was the biggest carry trade of all time.
Yeah.
And our argument was, China still has this insatiable desire and indeed requirement for capital. It needs money. And so it made sense as we looked at it at the beginning of the year. They had to form a legitimate bridge to tap this cheap money that was residing offshore and bring it through a legitimate manner onshore. And if it could do so and the latest incarnation of that would be this connect scheme between the Shanghai and the Hong Kong markets. But they've also developed enterprise zones where you can do that free exchange from the offshore to the onshore, and a host of other developments. And the net result of that is that you would get a rates convergence. But the great macro trade of 15, 20 years ago was the European rates convergence. They were very high in the periphery and they'd come down to the centre. And there was a notion that these very low rates in China offshore would come up to the levels that prevail domestically. That's pretty much come to pass, and we've made money from that trade. But why we've especially liked it is that because you're paying rates, if I'm wrong with my kind of sanguine take on where China is today, and there truly is a liquidity crisis, a banking crisis, what do you get? You get these SHIBOR, these intermarket rates, they shoot up, and the liquidity gets withdrawn from the offshore market, and I'm paying those rates. So if they go up, I'm paying a lot of money.
So as a trader, works either way.
Either way, which is really, if we started this conversation, define what makes it either macro or a good macro, it's finding trades of that nature.
Okay. And other trades in China?
I guess the other prominent trade, well, we have the currency.
The currency,
and so the currency, we are in the grips of evaluating whether we are moving on to this a new bull market for dollars, and clearly the sensitivities as we've discussed on the renminbi. We're long the renminbi via options, and again because the vol is so low, I can get a big exposure. But should it be that the dollar begins to appreciate versus the renminbi, we can turn that into a vol trade, and vol is very low. And so if you were to get an event, and I don't think you'll get an event, but if China was to have the misfortune of Korea or Thailand, etc., in the late 1990s, and you had a 40-50% devaluation, the volatility would go from 2.5% to 82. Right? You would just make a fortune. So we can tailor. So we have that. We don't think that's going to happen, and we think the most likely path is the currency appreciates. But we can rapidly adjust it if that view changes, and suddenly it's this huge vol, and we're protected.
So another trade that works both ways, really.
Yeah, and then the last trade, which it works only one way, is that if we're correct in our notion that the terms of trade are dramatically improving for the Chinese household sector, then what's your closest proximity to the household spending bonanza in China? And it's the internet giants. So we're along the Baidus and the Tencents of this world. We just think, and again, valuations are high, but growth rates are high.
It's another area where you don't care about the valuations at the moment.
Not at this moment, no.
Okay. Tell me what your favourite of all those trades are. Not just the Chinese one. Everyone. Come on, everyone has a most loved trade, a most loved market.
No, I don't. That's a hard question.
Okay, when we turn around, what would make you saddest if it failed?
I deal with failure all the time. Failure is part and parcel. It's moving on from failure. What would make me saddest, and again, is this notion of good hedge funds, is that you never fear the consequences of your risk taking. You don't fear the consequences of being wrong, and such is the way we put our book together. that's the space I am. So I struggle to answer the question because, a failure for me is not being contingent, is not being actively engaged, because if you can put it together properly in your portfolio, who cares if you're wrong? It's boring, move on to the next. There's always another trade.
There's always another trade. Thank you, Hugh.
Thank you very much.
The government should be borrowing, it would seem, heavily and investing in anything that yields a positive return. Wouldn't you think that the UK government could find more to invest in that would have some positive return?